Hey folks, thanks so much for taking the time, and thank you to the audience for tuning in. A huge thank you to Draper, Goren, Holm for hosting the Global DeFi Summit, one of my personal favorite conferences every year, and a favorite topic in terms of just capital efficiency in the space. So quick introduction on myself. My name is Kantorovich at FalconX. I lead institutional coverage. FalconX is a cryptocurrency financial services company that provides institutions with trading, clearing, and credit. So super excited for the panelists that we have today. We have Antonio from DYDX, Neeraj from CEXs, Robert from Liquidity, and Sunil from Saddle. So why don't we kick it off with some brief introductions? Antonio, you want to start?
Hey, I'm Antonio, the founder of DYDX. DYDX is a decentralized exchange focusing on derivative products. We've been live for a little over 3 years now. And most recently just launched our new product for perpetual contracts on layer 2 in partnership with Starkware.
Robert, why don't you go next?
Sure, I'm Robert Lauko. I'm the founder and CEO of Liquidity, which I started back in 2019, end of the year. And we launched it now like 3 months ago, roughly. And Liquidity is a lending platform which gives out its own stablecoin to borrowers without charging an interest rate. And it also improves on capital efficiency.
Neeraj, you want to go next?
Yeah. Hi, I'm Neeraj, a co-founder at CEXs, India's most compliant and secure cryptocurrency exchange. We have an objective of strengthening crypto liquidity in India so that billions of Indians can invest in crypto in a cost-effective manner. Having multiple product offerings like staking, spot markets, margin derivatives, and lending, we also have plans to launch global crypto platform very soon.
Awesome. Hi, I'm Sunil, the founder and CEO of Saddle. It's an automated market maker for peg value crypto assets. Most recently, we launched a new pool in collaboration with the Alchemix protocol for their new ALF product. Thanks for having us.
Awesome. So why don't we kick it off for those on the line that maybe don't know what DeFi or decentralized finance is, maybe with a brief introduction. Sunil, do you want to maybe at a high level start with how you might define DeFi today?
Totally. So the way I kind of think of DeFi is it's an open and permissionless version of what we kind of see in traditional finance. And one of the real big kind of powers of DeFi is all the different little like money Lego blocks that people are building through different protocols like Liquidity, for example, are composable. So people can kind of build new exciting products that kind of build on all these existing primitives.
Absolutely. And anyone want to add to that before we jump into capital efficiency?
Yeah, maybe one more thing to add is that, I mean, composability is a very important part, but I would also mention that there are various degrees of how those systems can be governed. So some of them are trying to have some democratic governance mechanism. Others are trying to be as autonomous as possible so that they are just playing by the rules that are governed by an algorithm, which is all like encompassed by the notion of DeFi.
Definitely. So there's definitely like a wide spectrum of what would be defined as DeFi, and as it pertains to the capital efficiency of accessing DeFi, it'd be interesting. I know with the panelists that we have today, some of you are more centralized and other more decentralized. On the centralized side, Neeraj, it would be really interesting to hear more on how you think about both access to DeFi from your platform today, and then how capital efficiency plays a role coming from a more perhaps centralized perspective.
Sure. So when we started building CoinDCX, we wanted to be the most liquid exchanges globally, right? And that was a big dream. Clearly, that would have required a lot of capital to be invested in market making in hundreds of crypto markets. But with the help of some great financial experts, we instead built a liquidity aggregation model on top of the centralized exchanges. So with minimum capital, we were able to bring liquidity of exchanges like Binance, Huobi, BitMEX, OKX at the doorsteps of our users. With just one single platform, users are able to access liquidity of all these top exchanges without moving funds from here and there, right? And more exchanges would be added. So we kind of build this model on the centralized layers to bring in capital efficiency in the markets. And we intend to do similar things in DeFi as well. We're still figuring out the best possible solution for that. But essentially the objective, in my opinion, moving in the DeFi markets would be, a single pool of capital should be able to cater to demands from multiple DeFi protocols. I think that would be a killer app in the decentralized finance, bringing in capital efficiency, capital being at one place, while all the applications built on top of that would be the ultimate view of capital efficiency in the DeFi.
Yeah, you bring up a really good point. So, Robert, to your point, right, DeFi is built on top of different protocols, and whether it's layer ones or layer twos, and each of these have their own different pools, and how they manage the pools between the different protocols really depends on the bridges that are currently built. Antonio, I'm really curious, what are your thoughts on that, and as it pertains to both DYDX, and maybe you can dive a little bit deeper into how DYDX views DeFi, but also on the capital efficiency front across these different protocols?
Yeah, I think capital efficiency on DYDX, the main thing we've really been focusing on is giving our users access to leverage, which just inherently makes their capital go farther. If you're trading with 10x leverage, it's like you come to the exchange with $100 and you can immediately buy $1,000 worth of Bitcoin, Ether, or whatever else you kind of want to invest in. And that works for market makers as well. So definitely echo a lot of Neeraj's points there. It's extremely important as an exchange to be able to build liquidity, and market makers can benefit from leverage as well. So it's kind of a double whammy where our customers can trade more because they're trading with leverage, and our market makers can quote and offer deeper markets because they also have access to leverage. On DYDX, one of the big improvements of our new perpetuals protocol, basically we had like an old protocol for perpetuals that ran on layer 1 Ethereum that was launched 1.5 years ago. And one of the main limitations of that protocol is that it only offered what's known as isolated margin, which effectively means that for every market that you might be trading on DYDX, say you want to trade both Bitcoin and Ether on DYDX, you have to collateralize those positions separately. So it was not very capital efficient in that sense. But one of the really big things that's kind of the layer 2 in our partnership with Starkware unlocked for us is now we can offer what's known as cross margining, which basically means that you just have one DYDX account and you can start trading whatever different assets you might want to trade out of that account. And again, market makers can profit from that too, because a market maker can just have one account on DYDX, can start quoting all the different markets they might want to trade on. The sum of all of their quotes can be much larger than the amount of capital they'd have in their account. So that's kind of how we think about capital efficiency at DYDX, and really think of it as kind of a core value proposition for our product.
Yeah, super interesting. Robert, how does that compare on the borrowing side, specifically in your world?
Yeah, this is interesting because also in the borrowing side, there is something called leverage, where you basically can amplify the collateral that you want to remain exposed to by borrowing more and basically exchanging what you borrowed to more of that collateral asset. So that's what basically Liquidity is also allowing to do in a more efficient way than maybe other protocols that are similarly built, by reducing the minimum collateralization ratio, because the minimum collateralization ratio below which you get liquidated is really what determines the maximum leverage that you can achieve by repeatedly borrowing, exchanging for more of the asset that you want to invest in, and then put this asset back to your position in order to be able to borrow more, and so on. I mean, this is already known from margin lending in the TradFi world. And I think here the key innovation or key ingredient of making this possible is making liquidations as efficient and as fast as possible, because you always need to have enough buffer for your system to cope with a falling price of your collateral asset. And the faster you can liquidate it, the less time you lose during which the price of this asset may fall even more. So by basically making the liquidations instantaneous, we can offer a much lower, only 110% minimum collateralization ratio. So that's the trick behind liquidity.
Got it. And are you guys protocol agnostic? So you're working across different assets, or are you specific to, let's say, anything Ethereum based?
In our case, it's really Ethereum based, and the only collateral that you can borrow against is Ether. We have this kind of extreme radical approach to decentralization that we only wanted people to borrow against Ether, which as a native token is completely decentralized.
Got it. Makes sense. That's super interesting. On the saddle side, I'm curious, I know Antonio mentioned as it pertains to market makers, as an automated market maker, how do you think about the liquidity needs and capital efficiency for something that's a bit more decentralized?
Yeah, totally. So capital efficiency is definitely one of the most exciting frontiers for automated market design currently. So we've seen some pretty new innovative designs come out of companies like Uniswap, for example, with their concentrated liquidity, which effectively allows users to provide liquidity over a certain range of prices. Another cool thing we've seen out of Balancer V2, for example, is the ability to put some of the assets that are in these automated market makers into other protocols. So they're actually earning yield while still being available to be traded against. At Saddle, we're actually looking into leveraging synthetics to provide increased capital efficiency, because synths have this really cool, basically attribute where you can trade between different types of synthetic assets with no slippage up to the size of the global debt pool. So the general idea is that if you have a bunch of different automated market maker pools that have a synthetic asset in them, you can then leverage synths as kind of an intermediary to kind of trade between different types of peg value crypto assets with very great rates that will rival centralized exchanges.
Interesting. Neeraj, I'm curious to get your thoughts on that specifically, coming from a more centralized exchange.
Yeah, could you repeat, Aya?
Yeah, curious to get your thoughts. I guess, from a centralized perspective, what are some of the gaps that you see today around areas where you could build on more capital efficiency that doesn't exist today in the same way, let's say, Saddle can kind of create that opportunity that you may not see on exchange?
I think two things would be very critical here. On the centralized exchanges, we would notice that the interest rates are very high. For example, if you want to borrow assets for margin trading, right, or if you want to go leverage on derivatives, the interest rates sometimes go up to 50%, even 70%, and I have seen 300% interest rate per annum, right, when you want to borrow more assets. Now, I think that's a very core critical problem when you want to have more capital efficiency, right? Efficient capital would allow us to borrow cheaper, right? That is very important. Right now, the interest rates are just haywire. If you want to long derivatives for 3 months or 4 months, you end up paying all of your principal, all of your wallet balance goes away, right? So I think that is a big gap. And one of the reasons could be that the centralized exchanges are also fragmented. You have 500 different centralized exchanges, right? And the capital is completely distributed across. So you need some kind of integration of exchanges, some kind of integration of the capital. The capital is divided across so many different platforms, and centralized exchanges generally do not talk to each other in any way. They are completely independent units. So decentralized exchanges, of course, you can build one protocol which connects with multiple protocols, right? We have been seeing relaying and concepts like that. But in centralized exchanges, this kind of efficiency is not there. So I think that is something which needs to be solved. And that would bring more capital efficiency. We want to see interest rates going as low as 5%, 10% per annum. That is very important for the markets to grow and mature up.
And what's holding, let's say, Coin DCX from using Liquidity or DYDX?
Frankly, nothing as such. the bridge between centralized exchanges and decentralized exchanges is still very difficult to build, especially when you are talking about exchanges built on Ethereum or Polkadot, right? Like DYDX. So I'll give you an example. If CoinDCX were to interact with DYDX and allow our users to interact with DYDX, we would have to connect with DYDX via our single exchange address, right? And that one address would give a lot of transactions, would put a lot of pressure on DYDX exchange, just single address, because that address is essentially collating all the orders of our millions of users and putting that, sending all those orders to DYDX via single address or maybe a few address. Now, in a decentralized world, that might not work, because tomorrow, miners could easily boycott you, right? One single address can easily be set aside, that okay, transactions from this particular address will not be mined. That can easily be done, right, once identified. So that's a core problem when we as an exchange want to send all the orders to DYDX via a single address. So essentially we'll have to create millions of address, and then one address per user at our end, and then connect with DYDX, right? Like one address corresponding to one user. And that is very challenging in terms of the operations and security, and that is what we are solving at the moment. At the end of the day, we do want that all our users who do not understand holding private keys, who are not very tech savvy, but they do want to participate in a decentralized world, they do want to lend, borrow, or do derivatives. We want to enable a gateway where people can access these markets via CoinDCX. And we are still working on that, building that bridge between the two worlds.
Got it. I guess question, Antonio, for you, how do you view centralized exchanges trying to access DYDX, and how have you worked with other centralized players similarly in the past?
Yeah, I think it's a really important problem for everyone in DeFi and probably in crypto in general to enable better bridges, kind of as Neeraj says, from CeFi into DeFi. It's something that we're certainly thinking about at DYDX. I think the beauty of decentralized exchanges is that it is technologically possible for centralized players to integrate with them, just in kind of the same way that you could trade on a decentralized exchange, of course, with your own wallet. Like Neeraj said, the centralized exchange could create their own wallets, could create integrations from their products directly into DeFi apps. And I think that's a really interesting thing, because it's not like you could just integrate or partner with one centralized exchange. Potentially all of them could integrate. And I think that's where the future is going over time. That a lot, some people will choose to custody their assets in decentralized wallets. Other people will choose to have, third parties custody their funds on a centralized platform. And both of those are totally valid. But we can, that's kind of the point of this talk, just really aggregate liquidity around these decentralized platforms, because everything can integrate with them over time. And yeah, in terms of to answer the question, what we're doing right now, it's really a lot of education on our part for centralized exchanges, starting to see really interesting moves with centralized exchanges into DeFi with some of the new layer 2 platforms that are coming out. I think one of the best ways centralized exchanges can integrate with DeFi and new DeFi platforms for now is, especially as a lot of DeFi platforms are moving to layer 2s, I really think centralized exchanges should consider integrating directly with a lot of these layer 2s to say, support a withdrawal to Optimism or Starkware or Solana or whatever the users prefer to use there. It's just a much more efficient experience for a user than kind of going to layer 1 Ethereum, paying really high gas fees to get off of Ethereum onto layer 2s. So that's, I think, where we should start. But certainly, I think the end state, like I said, is a lot of these centralized platforms having product experiences that are built on top of the DeFi protocols in the back end.
Yeah, definitely. Robert, Sunil, I'm curious, outside of like L2s, some things that have helped with capital efficiency, you have like rep tokens, so the ability to use Bitcoin on Ethereum platform, or other bridges like Near's Rainbow Bridge or Polkadot's Chain Bridge. Anything else you guys see today in the space that has helped in DeFi specifically for capital efficiency across these platforms and for your project as well?
So across platforms, I'm not quite sure, but in our case, what really helps for like being more capital efficient is sourcing what's already available in capital. So, I mean, there was this idea like in previous protocols that when you need to liquidate, for example, a position, you need to start looking for a buyer or somebody who bails out this particular borrower or this position that needs to be liquidated. And then the idea came from that, hey, why not use the existing players in your system? Like in our case, we are only using our stability pool mechanism and the borrowers themselves as a guarantor of last resort, so to say that they can act as underwriters or guarantors of their fellow borrowers. But I can also see like potential ways of collaborating, like where protocols can use their same pools, like some liquidity pool could be used for guaranteeing and securing loans on some other platforms. So I think there, like the space is really open for more innovation where you can double use or even triple use the same liquidity for multiple purposes so that you can really make it more capital efficient instead of just letting it sit around.
We have a couple more seconds, so Sunil, you're gonna wrap it up for us.
Cool. Yeah.
How do you see that efficiency?
I was just going to add, yeah, I think we're seeing a clear trend across the industry that, a lot of individuals are starting to prefer productive assets. So rather than just having their BTC sitting on BTC, not actually earning, any interest on that, we're seeing products, like Keep and TBTC come out where people can now trustlessly move their Bitcoin over from BTC to Ethereum and then start earning interest on, on their assets. And I don't think anybody has perfectly figured this out yet. There's different issues with a bunch of the different bridges and other solutions, but I'm sure DeFi as a whole is going to figure this out in the near future.
Thanks, folks, so much. I know we just touched the tip of the iceberg, but thank you again, Draper, Goren, Holm, for having us, and appreciate you all for giving us some insight on just a bit of capital efficiency across all these platforms. Thanks again.
Thank you.
Thank you.